Hi everyone. Today's video is for your friends, neighbors, and office colleagues who are masquerading as investment advisors. Often they will tell you, hey, always buy stocks which are profitable. Today I will take a contrarian position and help you understand that why you should take such advice with pinch of salt. What I simply mean is that yes, profits are important, but equally important is that if a company is able to generate enough cash flows in line with its profit. Let's look at these numbers and tell me if you are going to invest in a company which makes consistent profit in hundreds of crores. In first instance, you might say, yes, why not? Now, let me give you the full picture. I have taken these numbers from P&L statement of Ruchi Soya, particularly between 2010 till 2014 numbers. This was the period where all of us saw Ruchi Soya getting decimated to dust. Let me help you recap the story of Ruchi Soya. If you look at this chart, which is showing price of crude palm oil in Malaysian currency. Now, if you look clearly, you can see that between 1980 and till 2006, so which is almost like 25-26 years, prices of crude oil did not go higher a lot and it was within reasonable range. Now, after 2007, things started getting very difficult for companies who were relying solely on crude palm oil, and Ruchi Soya being one of those companies who are highly reliant on cheaper palm oil from Indonesia or Malaysia. So if you look at screener.in, you can see that in March 2010, the net profit reported was 172 crores, and in March 2011, it was 213 crores. In March 2012, it was 122 crores, and in 2013, it was 236 crores. So looking at these numbers, it looks like company is a fairly profitable company, and you would not have guessed it that there is something wrong which is happening in this company. So I have set the premise and context of today's video that if a company is reporting profitable numbers, it is good, but that is not the sole criteria to invest in a company. What should we look at? We should look at the cash flows and give importance to cash flows equally. So you can clearly see that in year 2010, the company made net profit of 172 crores and it had a very good cash flow of 186 crores. But the very next year, even though the profit number increased to 213 crores, but the cash flow went down to minus 190 crores, and this is a significant red flag. In year 2012, you can see the profit number was 122 crores, but the cash flow number has been significantly high, which is 904 crores. And whenever we see such numbers which is off, we should immediately question the data and try to dig further to see if the management is hiding something which we as retail investors might be missing. And in year 2013, company made a net profit of 236 crores, but the cash flow number is significantly off, which is minus 2000 crores, and hence we should immediately see if something is wrong with such companies. Hence, the message in this video is that there are quite a lot of tricks through which earnings can be manipulated, and hence it is very important that we should know the quality of earnings, which I am going to tell you how to do that. Now let me give you an example that how earnings are manipulated. So suppose a company buys a new asset, maybe it's a machine or it's a truck, and it costs around 10 lakh rupees and it has a usage span of 10 years. So what company does is that even though the cost of the truck or the machine is 10 lakhs, it is not going to report that expense in single year. What they usually do is that they report the expense in the span of 10 years, and hence they only report 1 lakh rupees each year in P&L statement as expense, and this helps to minimize the cost and thereby increasing the earnings or profit. Let me give you another example where revenues are manipulated. So imagine a company got a contract to make machines, and for simplicity let's assume selling price is 20 lakh for those machines, and the buyer says that I'm going to pay in next 4 years. But usually what companies do is that they report profit in single year instead of saying that okay, I'm going to receive payment in next 4 years, so let me not report the profit in 1 year. And that's how companies stack up the profit number, that even though they are going to make profit in next 4 years, they accumulate and try to report that number in single year. So this is how earnings can be manipulated both positively or negatively. Let me introduce a ratio through which you can catch some of these tricks of companies. And the ratio which I'm going to talk about is called CFO by PAT ratio, which is cash flow from operations divided by profit after tax. Let's take an example of Asian Paints and see if we are able to calculate CFO by PAT ratio for Asian Paints. If you look at screener.in, Net profit for Asian Paints in FY21 was 3,139 crores and cash flow from operating activity was 3,683 crores. If you plug these numbers, you get 1.17 as CFO by PAT ratio. Now what this means is that company is able to generate enough cash flows from operations, and whatever profit which is reported is not just based on receivables or underpayment of payables. Hence, CFO by PAT is a good ratio in terms of understanding the quality of earnings. So what you should remember is that CFO by PAT tells you about the quality of earnings, and hence it is called as quality of earnings ratio. Now if it is greater than 1, then it is good and you should look for companies which has CFO by PAT greater than 1 consistently. Similarly, if a company reports lower than 1 ratio, then you should stay away from such companies because it is highly likely that the management practices of such companies are not good and they might be having a lot of pending receivables or underpaying the payables. Now you might question that why investors like Warren Buffett prefer cash flows over net profit. Well, the answer seems that there is less room to manipulate cash flows vis-a-vis net profit, and hence you should and keep a close eye on certain trend. For example, rise in receivables without increase in revenue. So this simply means that company is reporting year by year a higher revenue, but there is significant rise in receivables as well. So what that means is that companies entering into a lot of long-term contracts where the buyers are not paying them every year, rather they are just committing that they're going to pay partially every year. Second one is fall in payables without fall in revenue. So you can also see that company is not paying its due to the suppliers or to their raw material suppliers, and their revenues are also not falling. This might also be a trend and you should also keep a close eye on such trend. On a high level, you can also look at the difference between CFO and net profit. If the difference is huge, either positively or negatively, then you should see that if there is a justifiable rationale behind it. Companies like L&T Infratech, Reliance Infra, or any other infrastructure based firm can be analyzed through this ratio. Because what happens that these companies usually get into a lot of long-term contracts, and hence you should always see CFO by PAT ratio for such companies. So the final point is companies having long-term business obligations like real estate, banks, NBFC, steel companies should maintain this ratio above 1 very diligently, and if they are not able to maintain this ratio above 1, then you as retail investor should be cautious in investing such companies. Hope you like this video. Thank you very much.